Right now, as you're listening to this, the market is still trying to process something that shocked even seasoned participants. Just a few months ago, Bitcoin was trading above $120,000, and the mood everywhere, from retail traders to institutional desks, was almost euphoric. Many believed the momentum was unstoppable, but then in a matter of weeks, the price collapsed toward the 70,000 range, wiping out hundreds of billions in market value. Moves like this don't just shake portfolios. They shake conviction, and when conviction cracks, markets behave very differently. If you look carefully, the warning signs were already there, but they appeared in fragments, scattered across different corners of the financial system. Trading volumes began to spike aggressively during the final stage of the rally, a classic sign of distribution that we've seen before in major cycles, from the dot-com peak in 2000 to the late stages of the commodity boom in 2008. At the same time, volatility indicators started expanding, not shrinking, which told experienced observers that this was not a stable uptrend. It was a crowded trade reaching emotional extremes. Then the real pressure began to surface. Liquidity conditions globally were tightening again. Treasury yields remained elevated, and risk assets everywhere, from emerging market equities to high-growth tech, started to lose momentum. Bitcoin does not exist in a vacuum. Despite the narrative of independence, it still moves within the gravity field of global liquidity. When dollars become more expensive and capital becomes cautious, speculative assets feel the impact first. Another factor many people overlooked was the psychology of large holders. After such a powerful rally, early investors and institutions inevitably rebalance. This isn't panic, it's risk management. We saw similar behavior in previous cycles, especially in 2017 and again in 2021, when sharp corrections followed periods of rapid appreciation. History doesn't repeat perfectly, but the rhythm of markets often echoes across decades. At the same time, global policy discussions added another layer of uncertainty. Regulatory frameworks were evolving, new proposals were being debated, and investors were trying to interpret what these changes would mean for capital flows. Markets hate uncertainty more than they hate bad news, and during those weeks, uncertainty was everywhere. Even optimistic narratives about long-term adoption couldn't fully offset the hesitation that was building beneath the surface. And yet, here's the contradiction you must understand. While prices were falling, many of the structural foundations of the network were not collapsing. Hash rate fluctuations, mining adjustments, and temporary stress among weaker participants were part of a process the system has gone through before. To someone watching only the price chart, it looked like weakness. To someone studying the mechanics underneath, it looked more like a painful reset. So, when you ask why analysts remain bold, even after a drop like this, you have to see both sides of the picture. Markets are emotional in the short term, but structural in the long term. Corrections of this magnitude feel catastrophic when you're inside them, but in the context of Bitcoin's history, they are not anomalies. They are part of the cycle itself. And this is the point I want you to remember as you look at the charts and headlines in the coming weeks. What you are witnessing is not just a price decline. It is a transition phase, a moment when expectations are being recalibrated, when weak hands leave and narratives are rewritten. Whether this phase becomes the foundation for the next expansion or the beginning of a longer consolidation is something no one can know with certainty. But one thing is clear, the volatility you are seeing now is not random. It is the visible surface of deeper forces moving beneath the market, forces that have shaped every major financial cycle in modern history. What most people watching the price charts still don't fully see is that the real pressure in this market is not only coming from traders, it is coming from deep inside the system itself. And when the internal structure of a market begins to shift, the effects can be just as powerful as any macro shock. Over the past weeks, one of the clearest signals has come from the mining sector. And if you've followed financial crises or commodity cycles before, you know that stress in the production layer is often the earliest warning that a reset is underway. You have to understand what mining really represents. Mining is not just computers solving algorithms. It is capital expenditure, energy contracts, infrastructure financing, and operational leverage. It is closer to running an industrial commodities business than a digital hobby. And when prices fall sharply while energy and borrowing costs remain elevated, the weakest operators begin to break. This is exactly what we are seeing now. Mining difficulty has dropped significantly, one of the sharpest declines since the shock that followed the China mining ban in 2021. That kind of move doesn't happen without real stress behind the scenes. When weaker miners are forced to shut down or liquidate reserves, it creates a chain reaction. They sell holdings to cover costs, which adds pressure to the market. Equipment is powered down, network dynamics shift, and block times temporarily stretch. These are not theoretical effects. You can see them in real network data. But here's the part many people misunderstand. These events, while painful in the short term, often act as a cleansing mechanism. Financial history is full of similar moments. In the oil market, high-cost producers are always the first to exit when prices fall. In the shipping industry, over-leveraged operators disappear during downturns, leaving stronger players behind. The same structural logic applies here. At the same time, there is another layer you must consider, and it is one that connects Bitcoin directly to the broader macroeconomic environment. The cost of capital is still high by recent historical standards. Interest rates globally are far above the levels investors became accustomed to during the era of quantitative easing. When money is cheap, inefficient operations can survive longer. When money is expensive, inefficiency is exposed quickly. This principle has governed every tightening cycle going back decades, from the Federal Reserve's actions in the early 1980s to the liquidity contractions that preceded the 2008 financial crisis. And yet, while all of this stress unfolds, something else is happening quietly in the background. As weaker miners exit, selling pressure from distressed operators begins to diminish. The network adjusts, difficulty recalibrates, and the system finds a new equilibrium. This is not a sudden or dramatic process. It is slow, mechanical, almost invisible to anyone who only looks at daily price movements. But over time, these structural resets can stabilize supply dynamics in ways that fundamentally change the balance of the market. Here is where the contradiction becomes impossible to ignore. On the surface, headlines describe weakness, capitulation, and fear. But beneath that surface, the system is adapting, removing excess, and redistributing power to stronger participants. This is the same paradox we have seen in countless financial cycles. During the banking crises of the 19th century, the institutions that survived the panic often emerged more dominant than before. During the commodity busts of the late 20th century, the companies that endured the downturn controlled the next expansion. So, as you stand here watching this unfold, I want you to recognize what kind of moment this really is. It is not simply a downturn measured in percentages. It is a stress test of the entire structure. Miners, liquidity, capital flows, and psychology all being compressed at the same time. These moments feel chaotic while they are happening, but when you look back at them years later, they often appear as the turning points that reshaped the market's foundations. And that is why the signals coming from the mining sector and the internal mechanics of the network matter so much right now. They are telling us something deeper than the daily headlines ever could. They are telling us that beneath the volatility, a structural transformation is taking place. And whether that transformation leads to renewed expansion or a longer period of consolidation will depend not on speculation alone, but on the fundamental forces that have always governed markets: cost, capital, and time. What I need you to see now is that the forces shaping this market are no longer confined to miners or traders. The real driver, the one that has quietly taken control of the direction of all major assets in recent years, is liquidity, global liquidity. And when liquidity shifts, everything shifts with it. You can watch charts all day, you can study technical patterns, but if you ignore liquidity, you are watching shadows instead of reality. Over the past year, the global financial environment has been defined by a difficult balancing act. Central banks are still dealing with the consequences of inflation waves that began years ago. Even though inflation has cooled in some regions, interest rates remain high compared to the ultra-low era that dominated the previous decade. That matters more than most people realize. High interest rates do not just affect mortgages or government debt. They change the behavior of capital itself. Money becomes selective, risk appetite contracts, and when that happens, speculative assets, no matter how promising, begin to feel pressure. You've seen this pattern before, even if you didn't recognize it at the time. In 2018, after the Federal Reserve tightened policy and reduced its balance sheet, liquidity drained from global markets and Bitcoin collapsed from its previous peak. In 2022, aggressive rate hikes across major economies triggered simultaneous declines in equities, bonds, and cryptocurrencies. These were not isolated events. They were liquidity events, and what we are witnessing now carries echoes of those same dynamics. But there is another layer unfolding at the same time, and this is where things become more complex. Regulatory frameworks are evolving, particularly in the United States, and the market is trying to interpret what these changes mean for the long-term role of digital assets. On one hand, clearer rules can reduce uncertainty and encourage institutional participation. On the other hand, every new framework introduces transition risk because participants must adapt to new compliance requirements, reporting standards, and capital constraints. Markets rarely react smoothly to transitions. They hesitate, they pull back, they reassess. You also have to consider the role of expectations. Financial markets are not driven only by facts. They are driven by what people believe will happen next. Right now, investors are watching signals about future monetary policy, future regulation, and future capital flows. They are trying to anticipate the decisions of central banks, the direction of fiscal policy, and the stance of regulators months before those decisions are actually made. That anticipation creates volatility because expectations change faster than reality. And here's the contradiction that makes this moment so difficult to interpret. While uncertainty about policy and liquidity creates short-term pressure, the same process is slowly integrating Bitcoin deeper into the global financial system. The more governments regulate it, the more institutions study it, the more it becomes part of the conversation about monetary alternatives, the less it exists on the fringes. That process is uncomfortable and chaotic, but it is also a form of validation. No asset that is irrelevant receives this level of attention from policymakers and financial institutions. As you listen to the noise of the market, I want you to focus on what really matters. The headlines will talk about daily price movements, about short-term rallies and corrections, about sentiment swinging from fear to optimism and back again. But beneath all of that, a larger story is unfolding. A story about how capital moves in a world where debt levels are historic, where monetary policy is constrained, and where investors are searching for stores of value that can survive the next decade of uncertainty. And this is why the macro environment cannot be separated from Bitcoin anymore. It is tied to interest rates, tied to liquidity cycles, tied to the strength of the dollar, tied to global risk appetite. It rises and falls within the same gravitational field as every other major asset, even as it maintains characteristics that make it unique. That tension between independence and integration is what defines this moment. So, as you stand here watching these markets move, understand that what you are seeing is not chaos without meaning. It is the collision of monetary policy, regulation, and psychology, all unfolding in real time. And when forces of that scale begin to interact, volatility is not an anomaly. It is the natural language of the market itself. Now we arrive at the question that is on everyone's mind. The one you keep hearing in interviews, in reports, in conversations between analysts who have watched this market for years. How can anyone still speak about numbers like $200,000 or even $250,000 while the price struggles far below its recent peak? On the surface, it sounds unrealistic, even reckless. But to understand why these projections continue to appear, you have to step back and look at the structure of long-term cycles, not the emotion of the present moment. Every major asset that has gone through monetization, gold, government bonds, even reserve currencies, has experienced periods where its growth looked explosive and irrational to those living through it. In the 1970s, gold rose more than 20-fold in less than a decade, driven not by speculation alone, but by a structural shift in the monetary system after the collapse of Bretton Woods. In the 1990s, technology stocks surged as the world digitized, and while the bubble eventually burst, the long-term transformation of the economy was real. These cycles are not smooth. They are violent, unpredictable, and often misunderstood while they are happening. Bitcoin's long-term thesis, whether one agrees with it or not, is built on similar structural arguments. Its supply is fixed in a way no major asset has ever been. Its issuance rate declines over time. Its global accessibility allows capital to move across borders without the traditional frictions that defined finance for centuries. These are not short-term trading factors. They are structural characteristics that analysts use when building long-range models. And those models, when combined with historical cycle behavior, are what lead to bold projections. But here is what most people miss. These projections are not predictions in the sense of certainty. They are scenarios, conditional outcomes, based on assumptions about adoption, liquidity, and macroeconomic trends. If global liquidity expands again in the coming years, if institutional participation continues to grow, if monetary instability in major economies pushes investors to seek alternatives, then prices could reach levels that seem extreme today. If those conditions do not materialize, the outcomes will be different. Markets are always conditional, never guaranteed. You also have to recognize the role of narrative in financial markets. Prices do not move only because of fundamentals. They move because of belief. When enough participants begin to believe in a long-term trajectory, capital flows in anticipation of that future. This is not unique to cryptocurrencies. It has driven every major bull market in history, from railroads in the 19th century to the internet revolution at the turn of the millennium. Narrative is not a distortion of markets. It is one of their primary engines. And yet there is a contradiction here that you must not ignore. The same narratives that fuel rallies can also create dangerous overconfidence. History is filled with examples of markets that overshot reality before correcting violently. That is why volatility is inseparable from assets that are still in the process of price discovery. The larger the potential future being imagined, the larger the swings that occur as the market struggles to price that future in real time. So when you hear analysts discussing levels like $200,000 or $250,000, understand what they are really saying. They are not describing tomorrow morning's price. They are describing a possible destination at the end of a long and uncertain road, a road shaped by liquidity cycles, technological adoption, regulatory evolution, and the psychology of millions of participants across the globe. And this brings us to the moment we are living through right now. The volatility, the corrections, the uncertainty. They are not signs that the story is over. They are signs that the story is still being written. Every major financial transformation in history has passed through phases of disbelief, fear, and exhaustion before reaching its next stage. Whether this market ultimately fulfills the boldest expectations or settles into a more modest role is something that time alone will reveal. But one thing is certain, and I want you to remember this as the noise of daily headlines grows louder. Markets are not driven by certainty. They are driven by possibility. And right now, what you are witnessing is not the end of a cycle, but a moment where the future is being negotiated in real time, where fear and conviction are colliding, and where the final outcome remains unwritten.